Let's talk about a few things we just observed in our exercise where we posted to our T accounts. One, we observed a double entry system at work. So for each transaction, we saw at least one debit and one credit entry. This agrees with a rule from earlier, and this will be a recurring principle as we make journal entries. Our debit side must equal our credit side for each transaction. Each transaction is recorded as a mini version of our balance sheet. Since the balance sheet has to equal in debits and credits, A equals L plus E, so do our transactions. Second point here, buying on account and selling on account uses two different accounts as opposed to the cash account. When we make a purchase on account, we are essentially promising to pay the debt later. This is a current liability and is commonly referred to as an account payable, which is a credit balance. Once we pay off the liability, our cash account dips by the amount owed, and our account payable also decreases by the same amount. In the case of a sale on account, we expect to collect cash later. This is a current asset and is commonly referred to as an account receivable, which is a debit balance. Once we collect the receivable, our cash account increases by the amount collected and our account receivable decreases by the same amount. Third and final point here, buying and selling inventory involves at least 4 accounts. From an accounting perspective, this was the most complex part of the exercise we just did. The key thing to remember is that our inventory can have two different values. One is the price that we pay for it, and second, hopefully higher, the price we sell it for. The difference between these two values is commonly regarded as gross profit or gross margin. When we buy the inventory, we hold it on our books at cost. When it is sold, we recognize the cost of goods sold expense, what we paid for the goods, and also the sales revenue, what we sold the goods for. Let's look at journal entries, which we will see are actually the tools that we use to update our key accounts. Let's progress with what we have just done with key accounts. How do accountants keep track of many transactions of varying complexity? The answer is they usually don't. With easy-to-use bookkeeping and accounting software available at reasonable cost, we only have to worry about recording transactions accurately. Technology takes care of the record keeping and calculations. So a journal is defined as a chronological record of transactions. The process of keeping a journal up to date involves 3 steps. 1. We must specify each account impacted by the transaction and classify each account by type. 2. We determine whether each account increases or decreases with the transaction. Determine if it should be a debit or credit entry using the rules covered earlier. And last, number 3, record the transaction in the journal, make the journal entry. The debit entry is made first and is entered along the left margin. The credit entry is normally below the debit entry and slightly indented to the right. You should include the date of the transaction just before the left margin, and you should have a brief description of the transaction, which is below the credit entry. Let's look at the first T account transaction we attempted. So if you recall, transaction A was January 1st, 2019, and entrepreneur Lori invested $5,000 into her new business. And this is kind of how Lori's journal would look after she makes the first entry. As mentioned, at the very left, before the left margin, we have our date, January 1st, 2019. Then in the second column, the wide one right here, we have the debit and credit. So cash is a debit, it's right up against the left margin. And over here in the debit column, we have a number, $5,000. Below that, and slightly indented to the right, we have our credit entry, which is to the capital account, Lori, comma capital, and the credit over here for 5,000. And at the bottom, below your debit and your credit, we have a brief description of what's going on, and I've just written down owner investment into business. So let's go ahead and try some of the other journal entries. So I have the transaction listed out here again from January 5th down to January 31st, and you have a good idea what a journal entry looks like. So why don't you just take a minute here and try B through F down in this journal which I have provided you.